Yeah, it really doesn't appear that way. We're still in that, we've talked about this before, that reset period, which we tabbed at about a 6 to 9 month reset. And I know that everyone's been talking about this, but it first started with valuation. We're about to get some earnings resets coming up in the earnings announcements recently. Some of the top-down strategists have already taken their estimates down for next year, but the bottoms up has yet to really materially change. And then I would say this: we've seen more outliers in this last 6 or 7 days. And I know, it's tough to point to any one week, but some of the outliers, going from negative real yields recently to positive real yields in this sharp of a move, is arguably never been seen. Secondly, the Bank of England's actions at a time when inflation's high, that's a tough call as well. Obviously, they have switched to financial stability from inflation. There's so many parts of this list, but I keep pointing to this. And this is something that is tough to answer at this point, but could this time, Scott, be the fact that the Fed put, the proverbial lifeline, is actually a Fed put for the bond market relative to the equity market? I mean, yields are very attractive here.
Well, we've heard people say that, including Ken Griffin yesterday at Delivering Alpha. We just showed one of your headlines saying that we're only halfway through this reset. Does that imply that you think stocks have a lot lower to go before the reset is complete, or not?
We're still of the belief that we've got, if you're thinking 12 months, right, if you have at least a 12-month hat on right now, we're still of the belief that your downside risk to upside is relatively equal. Will we, is the path of least resistance down still? It appears that way. But it's very difficult to ring the bell and say, ultimately, if the Fed literally says, we're going to wait and see because inflation's coming down at the turn of the year, 2-year yields peak out, the dollar peaks, risk on across the asset management industry is going to be what people will be talking about, in our opinion. And therefore, it's tough to know when that bell's going to ring. So we think there's equal risk to the downside, upside on a 12-month basis. Therefore, we're neutral. We want to be on guard. But for those that have excess cash, we're looking for opportunities come the turn of the year, early first quarter, to begin to think about that next business cycle.
Steve Weiss, who's sitting in front of me, thinks that earnings are going to be $200. The estimates are a lot higher than that right now. Yeah. Does that sound too dire to you, or about right, or what's your own projection?
Yeah, that's spot on with BofA Global Research, which has our earnings forecast at about 200 as well, which is about an 8% decline ending this year, somewhere around 219 to 222. The rest of the street, I know you all have seen this too. The range of earnings estimates from so-called 150, 160 on the downside to 240 on the upside. I don't know if I've ever seen that big of a range across the industry. Same thing with projections for the S&P. So when you get that wide of projections, I think neutral makes sense.